Welcome to the year 2026. Welcome to the era of the so-called soft landing. Welcome to the timeline where television pundits tell you that inflation is dead, the economy is booming, and the financial system is stronger than it has ever been. They tell you to look at the stock market, which is painting green candles to the moon, and they tell you to ignore the burning smell coming from the engine room. But while you were distracted by the latest celebrity scandal or the newest shiny tech gadget, something incredibly significant happened. Something that the mainstream financial media is desperately trying to bury on page 16 of the newspaper. On Friday, January 13th, yes, literally Friday the 13th, you cannot make this stuff up. Federal regulators quietly walked into a bank branch in Chicago, locked the doors, turned off the lights, and seized every single penny in assets. The bank was Metropolitan Capital Bank and Trust. And just like that, the first banking domino of 2026 has fallen. Now, I know what you are thinking, because I can already hear the comment section. You are going to say, Nick, relax, it's a small bank. It's only $260 million in assets. That is a rounding error for JP Morgan. Why are you making a 30-minute video about a tiny bank in Illinois? And that is exactly the attitude they want you to have. That is the apathy they are banking on. They want you to look at the size of the bank and dismiss the severity of the infection. Let me tell you something. When you find a cancerous tumor, do you ignore it because it is small? Do you say, oh, it's just a little tumor, it's not the whole lung yet, so I'm fine? No. You panic because you know that the size of the tumor does not matter. What matters is the pathology. What matters is why it is there and what it is doing to the rest of the system. Metropolitan Capital is not just a failed bank. It is a biopsy of the entire United States financial system. It is the canary in the coal mine that just dropped dead while everyone else is partying. So for the next 30 minutes, we are not going to do the mainstream media thing. We are not going to read the press release and nod our heads like good little sheep. We are going to rip this story apart. We are going to perform an autopsy on this dead bank. We are going to look at the rot inside the walls. We are going to expose the toxic cocktail of commercial real estate debt and high interest rates that killed it. And most importantly, we are going to talk about why this same poison is currently flowing through the veins of thousands of other banks across America, banks that hold your mortgage, your small business loan, and your life savings. The narrative that the banking crisis ended in 2023 was a lie. It was a pause. It was a commercial break. And now the show is back on. Let's look at the crime scene. Friday, January 13th, the FDIC, the Federal Deposit Insurance Corporation, swoops in. They execute what we call a Friday night massacre. This is standard operating procedure for the feds. They always do it on a Friday after the markets close. Why? Because they are terrified of you. They are terrified of the herd. They know that if they seize a bank on a Tuesday morning, Twitter goes crazy, people panic, and by Tuesday afternoon, there is a line around the block at every regional bank in the country. So they wait until the sun goes down, they lock the doors, and they spend the weekend scrubbing the name off the building. In this case, they executed a purchase and assumption agreement. Basically, they took the carcass of Metropolitan Capital and sold it immediately to First Independence Bank out of Detroit. It was a shotgun wedding. First Independence didn't buy this bank because they loved the assets. They bought it because the regulators made them an offer they couldn't refuse, likely with some very sweet backstops and guarantees. So if you were a depositor at Metropolitan, you woke up Monday morning and your debit card still worked. You logged into the app and maybe the color scheme changed, but your money was there. The FDIC will parade this around as a victory. They will say, see, the system works. No depositor lost a dime. Everything is fine. But let's look at who got wiped out. The shareholders, zero, gone. If you owned equity in this bank, thinking you were investing in the American dream, you just donated your money to the void. The unsecured creditors, wiped out. This is the brutal reality of the capital stack. When the ship sinks, the owners go down with it. But the real story isn't about who lost money this weekend. It is about why the bank failed. The official report uses a lot of sanitized regulator speak. They talk about unsafe and unsound practices. They talk about impaired capital. Let me translate that from bureaucrat speak into plain English for you. They ran out of money because they made terrible loans that nobody can pay back. Specifically, this bank was heavily exposed to the commercial sector in Illinois. And this brings us to the first horseman of the banking apocalypse, commercial real estate. You have heard me talk about this for months. You have heard other honest analysts talk about this. But the mainstream keeps telling you it is priced in. Metropolitan Capital is proof that it is not priced in. This bank was playing a game that thousands of other banks are playing right now. It is a game called extend and pretend. Here's how it works. You are a bank. You lent $10 million to a developer to buy an office building in downtown Chicago in 2019. Back then, interest rates were near zero, the economy was buzzing, and office workers were actually going to the office. Fast forward to 2026, that office building is 40% empty. The valuation of that building has dropped from $10 million to maybe $6 million. The loan is coming due. The borrower cannot pay you the $10 million because the building isn't generating enough rent, and they cannot refinance the loan because interest rates have tripled. In a sane world, the bank would foreclose. They would take the building, sell it for $6 million, take a $4 million loss, and report it to the shareholders. But if they do that, they become insolvent. If they admit the loss, they die. So what do? They pretend. They call up the borrower and say, hey, don't worry about paying us back right now. Let's just extend the loan for another year. We will pretend the building is still worth $10 million. We will pretend you are a solvent borrower, and we will pray that interest rates drop or a miracle happens. Metropolitan Capital ran out of road. They couldn't pretend anymore. The math caught up with them. And here's the terrifying part. They are not unique. They are typical. There are trillions of dollars of commercial real estate loans sitting on the books of regional banks across America that are marked at fantasy prices. They are marked at 2019 values in a 2026 world. These banks are technically insolvent right now. They are zombies. They are walking dead. They are just waiting for the coroner or the FDIC to come by and check their pulse. And notice the timing. Pulaski Savings Bank failed in January 2025. Metropolitan Capital failed in January 2026. This isn't a coincidence. January is the hangover month. Banks spend the fourth quarter trying to massage their numbers, trying to beg for capital, trying to find a white knight investor. When the year turns and the auditors come in, the game is up. The CEO looks at the regulator across the table and realizes there are no more cards to play. We are seeing a localized infection in Illinois right now, but do not be naive enough to think this is a Chicago problem. Chicago is just the first symptom. The same economic physics apply in San Francisco. They apply in New York. They apply in Dallas. If you hold a portfolio of office loans or retail loans, in a world where remote work is permanent and interest rates are sticky, you are sitting on a time bomb. But it gets worse. It is not just the bad loans. It is the cost of money. This is the second horseman, the yield curve. Metropolitan Capital, like almost every other bank, was caught in a vice. On one side, they have these old legacy loans paying them 3 or 4%. On the other side, to keep you from pulling your money out and putting it into a money market fund, they have to pay you 4 or 5% on your savings. Do the math. If you earn 3% on your assets and you pay 5% on your liabilities, you are not a bank. You are a charity. You are bleeding cash every single day you open your doors. This is the cash burn phase of the banking crisis. In 2023, Silicon Valley Bank died because of a liquidity run. Everyone pulled their money out at once. In 2026, banks are dying from a profitability crisis. They are slowly bleeding to death because their business model is fundamentally broken by the Federal Reserve's interest rate policy. And speaking of the Federal Reserve, let's talk about the absolute clown show that is our central bank. Jerome Powell and his cronies spent all of 2024 and 2025 patting themselves on the back. They told us they achieved the soft landing. They told us the banking system was sound and resilient. Sound and resilient. Keep those words in your mind as you watch federal agents padlock the doors of a community bank. The truth is, the Fed broke the housing market. They broke the commercial real estate market. And now they are breaking the banking system. But they are doing it in a very clever way. They are engineering a controlled demolition They don't want a spectacular explosion like 2008. They don't want Lehman Brothers. They want a slow, grinding consolidation. This brings us to the conspiracy, or rather, the strategy that is unfolding right in front of our eyes. It is called the Great Consolidation. Look at who buys these failed banks. It is never a new startup. It is never a group of local citizens. It is always another bank, usually a larger one, absorbing the smaller one. The powers that be, the Fed, the Treasury, the big Wall Street giants, they hate small banks. Small banks are messy. Small banks are hard to regulate. There are over 4,000 banks in the United States. The regulators would much prefer there to be 4. Imagine how easy it would be to control the economy if everyone banked at JP Morgan, Bank of America, Wells Fargo, and Citi. If you control the choke points, you control the people. When a small community bank fails, a piece of local autonomy dies with it. The loan officer at Metropolitan Capital probably knew the local business owners. He knew their families. He might have approved a loan based on character, even if the credit score was a little low. When that bank gets swallowed by a giant conglomerate or aggressive acquirer, that relationship is deleted. The decision-making power moves from Main Street to Wall Street. The algorithm takes over, and the algorithm says no. This is why we are seeing a credit crunch for small businesses. It is not that the money isn't there. It is that the gatekeepers are changing. The failure of Metropolitan Capital is a feature, not a bug, of the current system. They are letting the brush fires burn out the undergrowth so the redwoods can grow taller. But you and I, we are the undergrowth. Now, let's talk about the lag effect. This is a concept that economists love to talk about, but most people don't truly understand how violent it is. When the Fed raises interest rates, it is like dosing a patient with slow-acting poison. You drink it, and you feel fine. An hour later, you feel fine. A day later, maybe a headache. But 18 to 24 months later, your organs start shutting down. We are currently in the organ failure stage of the rate hiking cycle that began years ago. There is roughly $2 trillion of corporate and real estate debt maturing in 2026 and 2027. This is the maturity wall. All of that debt has to be refinanced. It originated when money was free. Now it has to be rolled over when money is expensive. Metropolitan Capital hit that wall. They couldn't climb it. And there are hundreds of banks lined up right behind them, staring at the exact same vertical concrete slab. The lag effect is undefeated. It takes time for the rot to eat through the foundation, but once it does, the collapse is sudden. This is why I actually laugh when I see headlines about the stock market hitting all-time highs while banks are failing. It is the ultimate dissonance. The stock market is essentially drunk on liquidity and AI hype. It is looking at the world through rose-colored glasses, convinced that the Fed will cut rates and save everyone before the bad things happen. But the bond market is terrified. The bond market is the smartest guy in the room. And if you look at what is happening with yields and credit spreads, the bond market is screaming that there is trouble ahead. The smart money is moving into safety. They are buying gold. They are buying short-term treasuries. They are getting the hell out of regional bank stocks. So what does this mean for you? Why should you, sitting there watching this video, care about a bank closure in Chicago? Because of contagion. Not the kind of contagion where everyone lines up at the ATM tomorrow. That is the old school bank run. The new contagion is the contagion of credit. When Metropolitan Capital fails, that money stops moving. The loans they were going to make, canceled. The line of credit for the local construction company, frozen. The mortgage for the young couple, denied. Now multiply that by 10 banks, by 50 banks, by 100 banks. You get a credit freeze. And in a debt-based economy, credit is oxygen. If you cut off the credit, you strangle the economy. Businesses can't make payroll. They fire people. Unemployment goes up. People stop spending. Corporate profits crash. And eventually, that stock market that is celebrating right now comes crashing down to reality. This is the cycle. We are in the early innings of a credit-led recession. And the scary part is the Fed is out of ammo. In 2008, they could cut rates from 5% to 0. In 2020, they could print trillions. But now, if they print trillions to save these banks, inflation, which is already sticky, will explode. They will turn the dollar into confetti. They are trapped. They have to choose between saving the banking system and saving the currency. And history tells us that politicians and central bankers will always choose to print. They will choose to sacrifice the value of your dollar to keep the game going for their friends on Wall Street. This is why the FDIC acted so fast. They are trying to patch the holes on the Titanic with duct tape, but they are running out of tape. And let's be real about the FDIC for a second. The Deposit Insurance Fund, they want you to believe there is a big vault of money waiting to pay everyone back if the system fails. That is a myth. The FDIC has a few $1 billion to cover trillions in deposits. The math doesn't work. If one or two mega banks fail, the FDIC is bankrupt in an hour. The only way they cover the deposits is by printing the money. So, sure, you get your dollars back. But what will those dollars buy? If they have to print $5 trillion to bail out the banking system, a loaf of bread is going to cost $50. That is the hidden default. They don't default on the number, they default on the value. So, knowing all of this, knowing that the system is rigged, that the banks are zombies, and that the regulators are lying to you, what do you actually do? First, you stop being a victim. You stop trusting the bank with your financial life. You need to treat a bank for what it is, a utility. It is a place to keep operating cash for bills. It is not a place to store wealth. If you have more than the insured limit in any single bank, you are playing Russian roulette. I don't care how nice the branch manager is. Move it, diversify it. Second, you have to look at the health of your bank. Go look at their loan to deposit ratio. Go look at their exposure to commercial real estate. If your local bank is lending 80% of its money to office buildings, run. Take your money and go to a boring, safe, giant bank. I hate the big banks, but in a crisis, the government has explicitly told us they will protect the giants and let the small guys burn. Don't be a hero. Be safe. Third, and this is the Nick Invest philosophy, you need to be your own central bank. You need assets that have no counterparty risk. When you have money in the bank, you are an unsecured creditor. You are lending money to the bank. If they go bust, you are in line. When you hold physical gold, there is no counterparty. When you hold silver, there is no counterparty. When you hold Bitcoin in self-custody, not on an exchange, but in a cold wallet, there is no counterparty. Nobody can lock the doors on your Bitcoin. Nobody can seize your gold on a Friday night unless they come to your house, which is a different problem. This is about sovereignty. The banking system is a control grid. The failure of Metropolitan Capital is a reminder that you do not own the money in your account. You have permission to access it. And that permission can be revoked by a regulator, a glitch, or a bankruptcy at any moment. We are watching the centralization of the world, the destruction of the middle class, the destruction of small businesses, the destruction of community banking. It is all happening by design. Metropolitan Capital was just a pawn in this chess game. It was sacrificed, and there will be more sacrifices. I am looking at the data right now, and I see dozens of banks flashing red. The next few months are going to be volatile. The headlines are going to get worse. The media will try to gaslight you. They will say it is contained. They will say the system is strong. They will say, don't panic. But remember, panic is only bad if you are late. If you panic first, it is called a strategy. If you panic first, it is called preparation. The silence is over. The alarms are ringing. The fire is inside the walls. Do not sit there and burn. Look at your portfolio. Look at your debt. Look at your exposure. Get liquid. Get real assets. Get educated. And please, for the love of everything holy, stop listening to the guys in suits on CNBC who are paid to keep you invested in the casino while the building is on fire. They are not your friends. Metropolitan Capital is gone. Who is next? I have a list. And if you are subscribed to this channel, you are going to know about it before the lock goes on the door. This is not fear-mongering. This is reality-mongering. The world is changing. The financial order is shifting. You can either be a casualty of the shift or you can capitalize on it. The choice is yours. But make no mistake, the events of January 13, 2026 were not an ending. They were a beginning, the beginning of the great unraveling. So, do me a favor. Go down to the comment section. Tell me, do you trust your bank? Have you noticed them cutting hours? Have you noticed them tightening up on loans? Let's share the intel that the media won't cover. We are building an army of informed investors here. Now, I need you to lean in and listen closely, because what I am about to tell you is going to make you look at your checking account very differently. We have talked about the FDIC. We have talked about the insurance, but there is a dark side to bank failures that almost nobody talks about until it happens to them. It is called the bail-in. Most of you remember 2008. You remember the bailouts. The government took taxpayer money, your money, and handed it to the banks to save them from their own stupidity. Everyone hated it. It was political suicide. So in 2010, they passed the Dodd-Frank Act, and the politicians went on TV and said, "We fixed it. No more taxpayer bailouts. The banks will have to save themselves." That sounds great, right? Until you read the fine print. How exactly does a bankrupt bank save itself? Where does the money come from if the government isn't writing the check? It comes from you. Legally, under the current regulatory framework in the United States and Europe, when you deposit money into a bank, that money is no longer yours. I know that sounds like a conspiracy theory, but it is black letter law. When you hand cash to a teller or when your paycheck hits your account, you become an unsecured creditor to the bank. You are lending money to the bank. In exchange, they give you an IOU, a digital number on a screen. In a bail-in scenario, specifically outlined in Title II of Dodd-Frank, the regulators have the power to take those IOUs, your deposits, and convert them into equity. They can literally take a percentage of your savings and turn it into stock in the failing bank. Imagine waking up on a Saturday morning, you log in to pay your mortgage, but your checking account balance is significantly lower. Instead of having $50,000, you have $30,000. And in your brokerage account, you suddenly own $20,000 worth of stock in Metropolitan Capital Zombie Bank. They call this recapitalization. I call it legal theft. They force you to buy shares in a bankrupt company to keep it solvent. And guess what? You can't sell those shares because the stock is halted. You are trapped. You just paid for the bank's bad real estate bets with your life savings. You might say, "Nick, that would never happen in America." Oh, really? It already happened in Cyprus in 2013. Depositors woke up and found that nearly 50% of their savings above the insured limit had been confiscated to save the banking system. It was a test run, and the global regulators watched it, took notes, and wrote it into the laws of the G20 nations. The failure of Metropolitan Capital was small enough that they didn't need to trigger a bail-in. They found a buyer. But what happens when a bank with $200 billion in assets fails? What happens when the FDIC fund is empty? The FDIC only has about 1% of insured deposits in reserve. 1%. If we see a contagion that hits 5 or 6 regional banks at once, that fund hits zero in an afternoon. When the insurance fund is empty and the political will for a taxpayer bailout is gone, the only option left on the table is the bail-in. They will look at the depositors, specifically the uninsured depositors, the small businesses, the retirees with large nest eggs, and they will say, "Sorry, for the greater good of the financial system, we need to give your deposits a haircut." This is why I scream at you to diversify. Because in a bail-in regime, your money is the collateral. You are the backstop. The bondholders get wiped out first, yes. But if the hole in the balance sheet is deep enough, and with commercial real estate down 40%, the hole is the size of the Grand Canyon, the bondholders' money won't be enough. They will come for the depositors. And do not think the $250,000 limit is a magic shield. In a systemic crisis, rules change. Emergency orders are signed. We saw in Canada how quickly they can freeze accounts for political reasons. In a financial collapse, they will freeze accounts for stability reasons. They will implement capital controls. They will tell you that you can only withdraw $50 a day. The closure of Metropolitan Capital was clean. It was surgical, but it was deceptive. It gave you a false sense of security that the government would always find a buyer. But as we move deeper into 2026, finding buyers for these toxic banks is going to get harder. Who wants to buy a bank loaded with bad office loans? Nobody. And when there are no buyers and the FDIC is broke, the bail-in mechanism is the break glass in case of emergency tool. It is sitting there in the legislation waiting to be used. The gun is loaded and it is pointed at your savings account. This is the ultimate betrayal of the social contract, but it is the reality of the system we live in. So when I say get your money out of the system, I am not just being dramatic. I am telling you to remove your wealth from the blast radius of a bail-in. Gold cannot be bailed in. Bitcoin and cold storage cannot be bailed in. Cash in a safe cannot be bailed in. Those assets are yours. They are not an IOU from a bankrupt institution. This is the conversation your financial advisor will never have with you because their paycheck depends on you keeping your money in the system. But my loyalty is to the truth. And the truth is, in 2026, the definition of money is changing. If you don't hold it, you don't own it. But wait, it gets darker. We have talked about the banks dying. We have talked about the government stealing your deposits. But there is a massive piece of this puzzle that explains why the stock market hasn't crashed yet and where all the risk went when the banks stopped lending. It's called shadow banking, specifically the private credit bubble. Here is what happened. After 2008, and definitely after the failures of 2023, the regulators came down hard on traditional banks. They said, you can't make risky loans anymore. You need to keep more cash. So the banks stopped lending to mid-sized companies. They stopped lending to risky tech startups. They stopped lending to leveraged buyouts. But did the demand for debt disappear? No. American corporations run on debt. They are addicted to it. So when the bank window closed, where did they go? They went to the shadows. They went to private equity firms. They went to hedge funds. They went to non-bank lenders. This sector has exploded to nearly $2 trillion in assets. It is unregulated. It is opaque. Nobody knows what the real value of these loans is because they don't trade on a public market. In the stock market, the price of Apple every second. In private credit, the price is whatever the manager says it is. It is marked to make believe. Now, why does this matter to you? Because of who is funding it. When Metropolitan Capital fails, it's a problem. But when the shadow banking system cracks, it is a catastrophe. Why? Because the money fueling this bubble comes from pension funds and insurance companies. That's right, your 401k, your state teacher's pension, your life insurance policy. In a desperate search for yield, because government bonds were paying zero for a decade, these massive funds poured billions of dollars into private credit funds. They were promised 10% to 12% returns. They were told it was safe. But these loans are floating rate. That means when the Fed raised rates, the interest payments on these loans skyrocketed. The companies that borrowed this money are zombie companies. They are tech companies that don't make a profit. They are retailers that are dying. They are struggling to pay this new expensive debt. We are seeing default rates in the shadow banking sector tick up vertically. But because it is private, you don't see the headlines. You don't see a bank run. You just see a slow, quiet rot eating away at the value of retirement funds. This is the transmission mechanism for the next crisis. It won't start with a line at the ATM. It will start with a pension fund telling you they have to cut benefits. It will start with an insurance company raising premiums by 50% because its investment portfolio blew up. And here is the kicker. The Federal Reserve has no window for shadow banks. If JP Morgan gets into trouble, it can go to the Fed discount window and get cash. If a private credit fund gets into trouble, there is no backstop. There is no Fed window for Blackstone's private credit vehicle. This liquidity mismatch is the most dangerous thing in finance right now. These funds allow investors to pull money out, but the loans they hold are illiquid. You can't sell a loan to a dying software company in 24 hours. So when the panic hits and the failure of banks like Metropolitan Capital is the trigger for that panic, investors try to pull their money out of these shadow funds. The funds put up gates. They freeze withdrawals. We have already seen this with major real estate investment trusts. They tell you, sorry, you can't have your money right now. This is the lock-in. The banks fail, so you run to alternative investments, and then the alternative investments lock the doors. The collapse of Metropolitan Capital is connected to this because banks used to be the primary lenders. Now that banks are retreating, the shadow banks are the only game in town. But the shadow banks are full on risk. They are lending to borrowers that the banks rejected. Think about that. The banks who are already bad at risk management, looked at these companies and said, no, too risky. And then the shadow banks said, hold my beer, I'll lend to them. And they did it with your retirement money. This is a subprime crisis, but instead of subprime mortgages, it is subprime corporate debt. And instead of banks holding the bag, it is pension funds and insurance companies. The systemic risk hasn't been removed. It has just been moved to a part of the casino where the lights are dimmer and the regulators aren't watching. So when I tell you to audit your finances, I don't just mean check your bank. I mean, look at your pension. Look at your 401k. What do they own? If they are heavy into alternative credit or private equity, you are exposed to the shadow banking collapse. The system is interconnected. The failure of a small bank in Chicago tightens credit conditions. That hurts the companies borrowing from shadow banks. Those companies default. The shadow banks take losses. The pension funds take losses. And suddenly, you are looking at a retirement crisis at the same time as a banking crisis. It is the perfect storm. And the weatherman, the Fed, is telling you it is sunny outside. Do not fall for the illusion of stability. The shadow banking sector is leveraged on top of leverage. And in 2026, leverage is death. The deleveraging process has begun, and it is going to be painful, brutal, and indiscriminate. And